we haven't had him on the channel, and it's so nice to have him back. Safir bhai, good
Thank you
morning.
for
Thank you
having
for
me.
joining
Pleasure.
us. Red, bright red in the morning. Is
Well,
this
it's
a, is
orange.
this,
It's India. It's orange.
it's orange, is it?
Absolutely.
Oh, I thought, oh, actually, I realized it's red, It's just that when the signals they reach here, they get slightly distorted. Okay, so orange. What does this color signify? If you have to say that, is this an indication of the market mood?
This is an indication of India and the fact that we should be believers in India.
Uh, it's all nice and great to talk about the long-term story. I'm just, putting a point here. But in the medium term, when I look at the whole fiasco in Adani group of stocks, how FIs are selling, given where earnings have moved in last 2 quarters, one would say that the long-term India story is great. But in the short to medium term, now wrinkles have surfaced.
Well, it's a debate because with all the negativity that we are speaking about in the context of FI selling, Adani issues, Russia, Ukraine, supply chain, inflation, interest rates, how low are we from the market highs? The question is there is a very large section of the market that is resilient, and it is for an investor to find opportunity. It's not going to happen that out of all the stocks that you own in your portfolio, everything will run towards the finish line. Somebody has to come first, somebody will come second. But the question is that how much of a setback is this? Not much. Despite so, if all the negativity has not been able to set it back, and also look at the results. I mean, an investor will eventually focus on results, and the result season has just gotten over. What is the level of results that some of our companies are reporting vis-a-vis what is happening in the rest of the world and all the problems that came with these results? They are extremely encouraging.
So I can see there are a lot of bulls on your back, behind you. Couple of them actually. So let's now get into an engaging conversation with Safir the Bull. What are you bullish? Where are you bullish? And how are you investing in this market?
So, Nikunj, the themes that I have been speaking to you, I usually do not change those themes, particularly if the themes are being playing out and the fixation is towards long run. The theme that I have spoken a lot on your television channel has been about healthcare, and you are aware of the fact that that has been a very rewarding theme. Of late, I've been increasing my allocations on banking, which is another sector that I've been a great believer in. The only difference was in the past, the belief was more centric towards some private banks, and thereafter became very bullish on some of the public sector banks. And I feel that the way the data has been spanning, the opportunities in the banking sector appear to be far better and far more crystal clear than they ever were. Some of them are not even at a one-time book value, and the legacy issues seem to be going. We also think, at least I think, that the credit cycle is on its upswing, and therefore the credit cycle, if everybody comes and talks about capital goods, Mark Mobius was yesterday talking about, or yesterday or day before, about infrastructure being his best theme, then these are real beneficiaries of the entire cycle. So banking continues to be of great focus, and of the last few days, my focus has been on new age companies, and I revoked my negative stand on almost all the new age companies which I had right from their IPO and listing days, and I've become a participant in some of them.
Quite interesting and quite a few takeaways from there, Safir. So let me talk about those new age tech companies. And let's pick up the one which came out with its numbers yesterday, Zomato, because there is a lot of criticism out there. The promoter wants you to analyze the numbers ex Blinkit. But a lot of the market men are saying, why should we bunk Blinkit and analyze the numbers sans that? Because that's very much part of the business. How are you reading into the earnings?
See, how I read into the earnings is by looking at market behavior. I mean, I have to only look at what I can do well. I cannot comment upon a lot of things where I do not have the competencies to do well. For me, there are a lot of factors that have made me positive on new age companies, and the company that you're talking about is one such example, but there are others as well. The first factor that I see is that if first of all is valuation, which is the sacrosanct principle for investing. A lot of these companies, when they raised capital, they were at insane valuation. There was almost like you were in a frenzy to miss out if you did not participate, and everybody wanted to own these shares without understanding anything about them. And suddenly they discovered that there is a disconnect between the companies and the valuation, and then these all came tumbling down 60-70%. So that itself became a positive catalyst, because that is intrinsic in the principle of investing, that you will look at the price of a company and the value that it offers. The second was that the higher prices came with very arrogant management. Some of them refused to give commentary. Some of them, brushed aside shareholders and made comments, etc. But later on, they realized the follies of a lot of bad business decisions that they had taken, acquiring one thing after another and making the balance sheet so complicated, and trying too many business models is not so conducive to the thought process of an investor. The third point is that some of these business models, when they sort of revamp themselves and say that, look, we are going to concentrate now on profitability, then I go back to a very interesting presentation that I have been a part of, which came from Professor Sanjay Bakshi, where he said that when you look at these businesses, sometimes these businesses may be losing cash in the pursuit of growth. So their balance sheets look optically very different from the situation where they decide then that we do not need any more growth capital, and now we will be generating a huge amount of cash. This happened in Amazon also, and this is likely to happen in some of these new age companies. The fourth factor that I see very positive is that the initial investors who came in and made a lot of money got away. And the secondary investors who came in after that on the institutional side are much more seasoned secondary market players. They knew what had gone wrong with the companies. They knew what had gone wrong with the business models. They knew what was wrong in every aspect of business, including the voting by the stock market, and thereafter have taken deliberated decisions to enter these companies. So there's a shifting of that hands itself is a very positive trigger that has happened in this. And the fifth factor is that a lot of these companies now are sitting on billions of dollars of cash. I mean, if you're sitting on billions of cash, and then you look at the market cap, the question is, in the long run, do you think that these companies will benefit? Now, to allude to the example of the company that you just spoke about, where I'm invested, my question is, how am I concerned if I'm beating the market by owning these and beating gold and beating fixed deposits and beating Nifty and any other instrument? I will continue to be a believer in some of these companies if the management do not mess up. And if the management mess up, I have the choice of moving out instantly.
That is the thing, right, Safir? Because on one hand, it's about the wait for profitability, and on the other hand, it's lucrative prices. So tell me, within this entire pool of new age tech companies, where lies your preference?
Well, at the risk of not being a SEBI registered advisor and therefore talking about my personal portfolio, I now own Paytm, I now own Nykaa, and now I own Zomato. All three stocks are in my portfolio.
And you're very active on Twitter. Your last tweet was less than an hour ago, where you said you'll keep Greaves Cotton on your radar. What else are you keeping on your radar, and what's the rationale for this?
See, the point is that you have to construct a portfolio, and when you construct a portfolio, your portfolio cannot have all the eggs in one basket. Even if I'm bullish on banks, it cannot be that banks dominate my portfolio and I ignore. And one of the advantages of being a diversified investor is that you get to buy an entry level ticket. And after buying an entry level ticket, do you get to know whether the movie is playing out well or whether it is not entertaining you and you want to move out. So when you buy a certain company, you take an initial position, you are, and particularly this happens in small and mid caps, you're basically betting on how the management plays the story and obviously how the numbers turn out. When the story becomes better, you have to average up, which basically is what I try and do, and therefore I increase allocations on some of the stocks that are winners. And if the story is going sour, then you move out, but you don't pay a huge price, because the mistake is not likely to cost you much. Now, in light of that, therefore, there is now a lot of scripts in my portfolio from diverse industries. And, if, for example, if one of my scripts is down today, it may not still impact the portfolio, or may relatively impact the portfolio lesser than what is happening with the market. And that itself is a good sign. So I continue to track a lot of results. The result season has been particularly good. Some of the stocks that are in my portfolio have, post results even gone up by 40 to 50%. And therefore, I have to be also conscious about the fact that I should not get carried away. If that movement is just because of some euphoria, then I will have to book some amount of profit. But if there is a cardinal change in the way the businesses are being valued and there is longevity of that, then I should continue to make allocations and not shy away from the fact that I may have bought initially at a lower price.
Wanted to ask you if you've had or do have any exposure to any Adani Group names.
Yeah, so I do own two companies, and you see, I make a distinction in my mind, having read on biases and having, if we keep talking about biases of every single kind, then you make a bias, which is, I don't own anything that I believe to be of an extraordinarily high valuation or a business model that I don't understand. I mean, if you ask me certain business models and I cannot explain them to you in simple sentences, then there's no point of owning them. But there are two companies there that I believe are mispriced, which is one is in Ambuja Cement and the second is Adani Port. The reason for that are one, of course, that they have a lot of institutional holding to begin with, and therefore the allegations of concentration in the hands of few is not apt in those cases. Secondly, they are real assets. One of them was acquired by a bidding process where there were other competitive bidders. And given the fact that that asset can easily be passed on to another party today, they were at 380 rupees. There were bids that were coming in. Is very easy to decipher. And thirdly, the valuation of cement is done based upon the tonnage and how much of efficiency you are able to bring in. It's not such a rocket science business. So I do believe that the asset value that exists in that company is very different from the situation that exists in some of the other companies. Now, with Adani Port, the logic is also similar, which is first, the institutions own it. Secondly, it's a fact that it is a monopoly in the port business in India. Now, as Nikunj was talking, if you're long-term bullish on India, you're also long-term bullish on the trade prospects of India and whatever happens at the ports. And then you look at the substitution value of these ports and say, if I was to acquire these ports or if I was to recreate these ports, where do I get the locations? Where do I get the licenses? Where do I get the infrastructure? And you come and say, you know what, this appears to be an opportunity. And also, you're buying at a very different price. I was not an investor in these until a few days back. The market brought them down to a level that forced me to become an investor.
So let's talk about your top three holdings, what they were exactly a year ago, and what are your top three holdings now? Have your top three holdings changed?
Top holdings simply because of the escalation in price. So I will give credit to the market for having taken him to the levels that they are at. I have spoken to you about State Bank of India, spoken to you about ICICI, and those they continue to be my top holding. And the others top holdings are relatively smaller companies. For example, I own a pump company called WPIL, where my entry price was significantly lower. Now, just in last 2 days, the stock is up 40%. Even today, it is limit up. Now, I will have to go back in the evening and see how it has changed the allocation. That is what a dynamic portfolio is. You don't decide the allocation. The market reward decides the allocation, or the market punishing a particular stock decides the allocation. And then you have to revisit your decision to think that was it an error on my part, either of omission or commission. I should have bought more, or I can still buy more, or should I be pruning my stake in some of these companies. So, for example, in pharma, like I exited most of my pharma positions a few months back, and I wrote that I don't see any triggers. I mean, COVID was past. The people are moving on to other businesses. Infrastructure is going to be built all over the world. Now, if pharma corrects too significantly and I decide to find an opportunity there, then I will buy it. And if it rewards me, it will become in my top holdings, because that's how it is supposed to be.
Let me phrase my next question slightly differently. One or two large cap stocks where in next 3 years you expect a 50% upside. That's a reasonable estimate for a large cap stock in 3 years. And one or two mid cap stocks where you think in 2 to 2.5 years they potentially could give you 100 to 150% upside. That's a reasonable time frame for a mid cap stock, considering that you will be taking higher risk. Fill in the blanks, Safir bhai.
See, as far as large caps are concerned, I am open to admit the fact that I do own the large cap banks, and I will continue to be a believer in the fact that some of them may go up by 50%. There is a very big difference when it comes to, for example, a large cap stock which is very capital intensive, and very different when it comes to a stock which is sitting on capital waiting to be allocated. So I'm hoping that India, as long as India does well, a lot of these banks will have very good offtakes. And also the level of innovation that has happened between them and several collaborative business models that they're entering into is very interesting. So much so that even banks that I traditionally did not like, which could have been, some of the other PSU banks, not the primary ones like an SBI or some of the other private sector banks, they're also showing numbers that are talking. So it's like everybody in the class is doing well. You're literally sitting in an IM or an IIT class right now. as far as mid caps are concerned, I think 50% returns is a very reasonable expectation in the next 3 years. You have to look at the longevity of a sector. For example, there are companies that have undergone capex during the last 1 or 2 years, and this capex has come when the rate of interest is high. It has come when the world has been disrupted. It has come when the offtake and the margins were all squeezed. They will become beneficiaries, and some of these will also include chemical names, some of these will include manufacturing names, some of these will include cement names. Cement was just one example. It's not typically a sector that I track too much. So I would rather have the patience. Logistics, for example, I would rather have the patience to continue buying in these sectors, because if in 3 years I can make 50% or more, or even perhaps even double my money, I would have done very well as an investor. And if I have not, then my rationale of why I invested must be tested. And that rationale is not tested by a quarterly result. It is tested when the business models lose the potential to grow.
So we've discussed the theory. Now the practical part, the names of mid-cap stocks.
Like I told you, I'm not SEBI registered. I don't know what extent I can talk about, but okay, what I'm doing personally, I'll see. Like, I do believe that in the logistics sector, companies like Blue Dart that are expanding rapidly, they are buying planes. Both Blue Dart and their parent DHL are talking about a very large capex. They're a technology leader. They're a market leader. The market all of a sudden reacts to a slowdown that happens because ATF fuels, and then one day Amazon decides to announce 2 planes, so the market reacts. The same day DHL announced 3 planes, or the next day, nobody cares. So you have to look at opportunities. You have to look at the cash that these businesses generate, the kind of dividends that they offer, their parentage, their lineage. Similarly, TCI Express, which a stock that is corrected in the same sector, look at what the company has done. Of course, the stock is still more than double from the level at which I entered, but look at what the company is doing. They're right now going through a buyback. So the logistics sector is telling you, and even companies that I don't own there, like a Mahindra Logistic, or another logistic company that I do own, Aegis Logistic, their commentary seem to suggest that there is a lot of work that is happening there. Even smaller players are registering. So I will be a believer there, at least on the long term, and I do believe that the sector is a sunrise sector in India. So that's one. And the second are some of these amine companies that are now have corrected, because they were fair to come on channels like yours and tell the world that, look, we are facing issues with APIs. So if the management is honest, they're coming and saying we have API issues, but we are doing capex, and over a period of time, this capex will translate into something beneficial for us. I mean, then it cannot be that all of a sudden you come and say moving away from generic into specialized chemicals, the story is wiped off. So the market has punished them because the results were as the management said. But I think that there lies a great opportunity. Also, I track promoters. Like, if the promoters are doing capex and they're not selling their shares and they're not desperate to sort of raise capital and they're not stranded in some way, then it's a clear example. And one of the reasons why I succeeded in a company called Alkyl Amines, which went up more than maybe 70, 80 times from the time I bought it, is because when they were doing an expansion in Dahej, nobody was even talking about capex. So these companies in the amine sector, according to me, should be, they're fantastic companies. They have an immensely credible record, but the market vote is currently against them, and vote against the stocks that otherwise have a long-term horizon is usually a thumbs up.
Wow, Safir, we didn't think we'd get those many names out of you, but thanks so much for being fairly upfront, honest, and giving us a take as to where you're seeing long-term potential, large caps, mid caps as well included. On that note, Safir would like to thank you for joining in on the show. Good to have you on board. Quick check-in on the